Yep.
All right. Good afternoon, everyone. It's Fed rates day. We got decision day from the Fed. So 25-point cut. Key takeaways: 75-point cut, most likely scenario through the end of the year. So that's another 50 basis points, another 0.5% off. But there's a whole lot of people who are disagreeing with that, expecting fewer cuts. So you have a pretty divided Fed there. We also have some key points Powell was making about potentially a shrinking or flat labor force. He talked a lot about downside risks to the job market he sees as rising. And so he's seeing the balance of risks, and this challenge, he kind of hinted at, was stagflation. So want to pull in Scott from a rates desk and talk a little bit about what his reaction was today to this and what he saw in the Fed funds forecast.
Yeah, thanks, Ian. I think, for the first time in a long time, it seems like the market had it right heading into the meeting, right? I mean, the market was expecting and pricing into rates, to long-term rates, 3/4 point cuts for this year. And that's essentially what the Fed has signaled via the average of their dot plot. So that was a takeaway for me. Markets, rates as they were trading before the Fed announcement to where they were trading, well into Chair Powell's press conference, about the same level. So not as much volatility around this announcement as there has been in some past announcements where some of the comments have been a little bit surprising. What also caught me or struck me too is the Fed signaling some further cuts as expected, but they also noted that inflation was ticking up, right? And if you look at their quarterly projections, they noted that inflation won't get to the 2% target level until 2028. So I think that's another interesting facet to pay attention to. While they currently moved their focus now to employment, as you mentioned, Ian, with some of the recent employment figures being a little bit concerning, inflation is still going to be around, and they're going to be easing into an environment where inflation isn't immediately dropping, but they're a little bit more concerned about employment, it seems like, right now.
Yeah, I think that was an interesting takeaway. And they expect the unemployment rate to tick up another 0.2 this year. So their median projection is 4.5% unemployment by December. So it really is, Powell was hinting at somewhat of a stagflationary scenario where, the balance of their risks of their two mandates are really coming into conflict. And he was talking about that. That's a lot of times it's easy in some ways. Although it's funny, I bet you at the time he was not calling it easy, but he says it's a bit easier because you start to say, hey, we're worried one of these metrics is not working well. Yep. Unemployment is too high or inflation is too high. To have both be too high is a challenge. One thing that's interesting is I love the 2-year target. Mike McKee from Bloomberg actually had a really funny question where he pointed out that it's always 2 years away you hitting your inflation target. That has been true for several years. It takes you a while. There is some expectation we're getting pretty close next year, but still elevated, and so it's 2 years out hitting their inflation target. At the same time, we also have unemployment moving in the wrong direction and getting to a little level, I think, a little higher than they'd like. And he did acknowledge that sort of the marginal folks in this labor market, that it's a strange labor market, that you essentially have supply coming down and demand coming down at the same time. So it's somewhat in balance. Typically in balance, you have jobs growing and the labor force growing, and so you're in growth. And this is really a new dynamic for the United States because of the shift in immigration. So you have that, but he's also acknowledging just a lack of turnover. And we've been talking about this and talking to employers about this, and a lot of companies we work with are saying the same thing. They're not seeing a lot of turnover in a lot of categories. And if recent college grads, have a lot of empathy for them. It is a tough job market for those folks. You're seeing some marginal workers, kind of unemployment rates ticking up around those subcategories within the unemployment report. But those prime working age workers, because there aren't a lot of layoffs, if you're talking 25 to 54-year-olds, people in the heart of their career, they seem to be doing okay. They're not switching much. They may not be finding much, but they're still getting modest raises and they're still doing okay. So it does put the Fed in a somewhat awkward, odd position. Yeah, I do want to show the dot plot here. So if Adam could pull that up, we're going to show something here. So this is the shift in the dot plot. So essentially, let's lay out what this is. This is where Fed governors, each one of them is votes, and each dot represents a Fed governor. So let's see what they think. You can see all these Fed governors basically think that we should have 2 more cuts this year. These Fed governors up here, this other plural, so you have a plurality right here, a slight majority down here. But this is 9 dots here. You have 9 dots up above it. So you have one governor who kind of did a soft dissent here. They said no cuts in their forecast, but they agreed because we had a unified Fed outside of the new governor, Stephen Myron, who wanted 50-point cut. I would bet he's the new projection down there, the new governor, Trump's recent appointee. Wanting really aggressive cuts for the rest of this year, but you can see the rest of the board, 75 total. So this is the first 25, another 50 to come. You can see, essentially a pretty large group don't want any more cuts. So you do have a somewhat divided Fed right now this far out. I thought those were some of the interesting points, somewhat of a divided Fed. Realistically, though, if I'm betting on it, I'm still going to bet on 75, but I've been saying 75 for a while. And I think one of the other things everyone's not talking about is that October jobs report is going to be ugly, because I expect a good number of those federal employees who took those deferred resignation offers show up in the jobs report then as not being employed because you're in the new fiscal year. And a lot of those were through September 30th. We see that in November, and that really puts a lot of political pressure on the Fed to keep cutting in December.
Yeah, I agree. So 2 more cuts this year, in the median dot plot, 1 cut in 2026 and 1 in 2027. I think as we step back, we got to remember, they're not cutting because of a recessionary scare, right? They're cutting to get to a more neutral level of rates, and I think that's a moving target. And also what was surprising in their summary of economic projections is that they actually upped their growth forecast for next year and in 2027. So I don't think they're scared about necessarily the U.S. going into a recessionary type of scenario. So I think as you look out into the future, Powell made a mention of they'll still kind of take each data point and make these decisions meeting by meeting. But I think what the forecast is giving you is a pretty aggressive and a pretty, a decent number of cuts priced in that, allows you to kind of take advantage of that forecast where the rate level is. And if things play out as expected, you wouldn't see much change in longer term rates as they are today. And really on the flip side, if we do get into a reaccelerating growth scenario, some of these cuts may not come to fruition, and interest rates might be a little bit mispriced accordingly. So a lot of variables out there in play that it'll be interesting to see how this ultimately plays out based on what's expected today.
That has been a funny dynamic for a while, that, if you took the low end on how many cuts are going to happen for the last couple of years, I kept doing that as an economist. I'd be low versus the market. I'd be right. And this time, I think I was really going for 75 just because I thought the numbers were lining up that way for the rest of this year.
Mm-hmm.
I came around a bit. But the cuts this year, there were a number of people beginning of this year were saying 75 points throughout the entire year, but they were front loaded a lot more than has happened. So if you locked in those rates, September a year ago, you could have gotten some really attractive long run rates because there was, people were expecting a fairly aggressive cutting cycle. And then of course, growth outperformed. We do seem to see some seasonal factors that are kind of pushing up the growth numbers in the seasonal adjustments. A little stronger in winter, a little softer in summer. It seems to be a pattern. I think we kind of had that dynamic in post 2009 recession. You again had this weird seasonality, like the seasonal adjustments weren't quite nailing properly. And so you started to see the same growth pattern where you got a little nervous part of the year, and then kind of the same time of year, things would look a little better. And maybe it was more seasonal adjustments and the economy really performing differently. Overall, though, yeah, I think this is, 75 seems baked in right now as the most likely. At the same time, if we got a little stronger inflation data, as in worse inflation data, a little better jobs data comes in, you're maybe 2 votes away from getting fewer than 75 cuts. So, I don't think 75 is guaranteed. We could get some better numbers between now. And if you look at that dot plot, like I said, there's 10 people at 3 cuts or lower, almost all of them just at 3 cuts this year, 2 more cuts. And there's 9 at 1, 0, or -1 cut, essentially one hike. And so you break that down, you're thinking, okay, it doesn't take many votes to move for this to be a different rate path. If not, we really appreciate you joining us here on our LinkedIn channel. Please, follow and subscribe. Check us out. We're going to hopefully be posting a whole lot more video content that you find interesting and relevant to your businesses.
Yeah, and we'll update you in October at the next Fed meeting and see what things happen.
We'll see you in a month.
Yep.